Next guest called the market bottom in 2009. He's been bullish for the last 18 months, but this month he switched to neutral. Downshifted here. Michael O'Rourke is chief market strategist at BTIG. He's with us this morning. Good morning to you, Michael. You know, in the past decade, investors, if they wanted growth, they went to the BRICS. They went outside the U.S. Why are you bringing money back home right now?
I think that's it. The past decade, we've had such a subpar economy here in the U.S. Although the equity market recovered from the 2000-2002 bear market and the economy recovered from the 2001 recession, it was a debt, it was a leverage recovery fueled by debt, and the currency market saw that. That's why the dollar depreciated. And I think we're seeing that major pendulum shift now, where people are concerned about slowing in Asia, they're concerned about problems in Europe, and I think that money is going to come back home. People are going to see the U.S. as the best combination of growth, stability, and value.
Even though there are still concerns about high unemployment, still instability perhaps in the housing market as well. Is this just a relative bet here, or are you saying there's real strength in the U.S.?
Well, I believe there is strength in the U.S., but it is also a relative bet, and I think that's important to recognize. Most of the recovery process here has been a reflation process among central banks throughout the world. So you have these global assets that need to find a place to hide. During the crisis last year, they went to treasuries. It was the safest place. I think this time around, you're looking at a U.S. economy that's in recovery. It's rebounding much stronger than people expected. So they'll look beyond just treasuries, and they'll look to U.S. stocks and other assets here. That being said, I did switch to neutral early in the month in the sense that the market has discounted a large portion of the recovery in the near term, but still, the U.S. is a much more attractive place than other markets globally.
I'm looking at a breakdown right now on my screen here of U.S. stock market foreign exposure. And in 2009, 33% of profits earned by U.S. corporations were made abroad. So if you're really bringing money back home, you're still investing in overseas. I mean, what is it that you're recommending here specifically if you're trying to just get exposure to the U.S.?
Well, I mean, that's the great thing here. What we've seen over the past couple of years is a major global upheaval. You'll remember back in late 2007, early 2008, the globalization process was supposed to be the thing that saved us from the Great Recession. At that time, I didn't believe that argument, but those trends are still there longer term. So what really happened here is the bar was reset as the whole global economy corrected, and in the end, the best, the people left standing happened to be U.S. multinational companies. Whereas, for example, here in the U.S., the consumers are over-levered, governments around the world are over-levered. The people who are flush with cash and capital are corporations, and they're the best allocators of capitals. So these corporations will be able to act most nimbly in this very, it's still not a robust environment, it's a recovery environment, but they're best positioned to capitalize on it.
Like what sectors?
Right now, I like the financial sector, I like the healthcare sector, and I like the technology sector. I think they're all well positioned as far as where they are in their cycle, as far as where valuations are. And I think, obviously, financials, we're going to learn more about financial reform and how it's going to shape up this week. So there's some headline risk there in the near term, but they've had a lot of competition eliminated. Technology, obviously, this whole global growth story is going to, technology stocks.
Are you saying that you believe in decoupling?
I believe decoupling happens to an extent. The example I would give is, Shanghai is an important market in China, but it's not an important market here, so that market's down 20%, whereas markets here are flat. You could say that there is a decoupling that's occurred there to this point in time. Hong Kong's a little more integrated with us, so they're only down 10%, whereas Europe is highly integrated, so the only really decoupling we're seeing is in currency values, whereas the markets are, performing on par. But the U.S., on a dollar basis, the U.S. is gaining on a relative basis.
All right. Thanks so much, Mike O'Rourke, joining us from BTIG this morning.